Now we're getting into it. I think there are two grand decouplings. One, I do think there's a decoupling of crypto from high beta tech stocks that is going to happen at an increasing rate. And I think that correlation is going down. And I think there is a decoupling between different crypto assets, right? Like fundamentally, Bitcoin is so different from Ethereum. Why would you think that the correlation should be more than like 0.6? Doesn't make any sort of sense. The only reason it did was because we had these overarching crypto industry factors that were really important, like adoption, like regulation. But all that's been blown out. Now we're in this fundamental era. So I think there is going to be a grand decoupling. I think we're going to start talking about, almost the crypto market being as diverse as the stock market, right? Not just the tech sector, but the stock market, tech versus energy versus healthcare, Bitcoin versus ETH versus, DPIN versus, I think you're going to have that kind of dispersion, which is what we should want. If these projects are going to be fundamental, transformative of the real world, then the fundamentals should drive their returns. I think that's where we're going. And so you're going to get that kind of dispersion and correlations.
You're listening to CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance, presented by CF Benchmarks.
Hey everybody, thanks for joining us for another episode of CFB Talks Digital Assets. I'm Ken O'Delegate, Head of Content, and I'm joined as usual by my colleagues, Gabe Selby, who's Head of Research, and Mark Pilipchuk, who's our Research Analyst. Today, we have someone with us who hasn't been with us since basically 2 eras ago. Well, that's how it feels like anyway. Mr. Matt Hougan, who is the Chief Investment Officer of Bitwise Investment Management. Matt, we're stoked to have you back on board.
Oh, I'm so excited to be here. This is going to be a lot of fun. I've been looking forward to it.
So as my preamble suggests, that a lot of water has gone under the bridge, even in the last few weeks. So there's any number of points that we can actually start the conversation. As a starter for 10, from your vantage point, how is the investment advisor piece looking? How are financial advisors, what stage are we at now in terms of the adoption theme with RIAs, I guess, in particular?
Yeah, a great question. It's what we spend most of our time here at Bitwise doing. I was just at the Barron's Top RIA Conference presenting to 100 of the top RIAs in the US. I think we're right at the hockey stick portion of the exponential growth curve. I'll give you some data and then some anecdote. We do a survey every year of financial advisors, primarily RIAs. We've been doing it for 7 years, which is really fun because you can compare what they say year over year over year. When we started, 4% had allocation to crypto and client accounts. In year 6, 11% did. Last year, we did the survey just after the election, 22% did, and that number was expected to double in the year ahead. So just to put that in context, Bitwise did 6 years of meetings and went from 4 to 11%. And then we got the ETF and Trump, and we went from 11 to 22. All the same amount of growth in 1 year that we had in the previous 6. And then next year, I think we're going to get 2x that growth. The thing about exponential growth is you sort of don't notice it until you get to the high compounding numbers. I think we're at the high compounding numbers. Another piece of data, this is the market Bitwise serves. 18 months ago, we managed $1 billion. Today, we manage 10. So I think we're in that exponential growth phase. And then on the anecdotal side, everything that I see when I go out and meet with financial advisors is pointing in the same direction. As an example, when we go out to meet to the few areas that can't yet buy a Bitcoin ETF, like the national account platforms, the Morgan, the Wells, the Bank of America, the UBS, meetings that last year would have 1 or 2 people in it now have 10 or 12 senior leaders in it. People who used to allocate 1% to crypto are now allocating 3%. I don't want to come across as Pollyanna, but I do think we're entering a massive era of financial advisor adoption of Bitcoin and crypto. I think they're going to regularly have 3 to 5% of their portfolio in it. I think we're going to get record ETF flows this year, bigger than last year. And every piece of data I look at And every meeting that I have suggests that that's where we are.
So we're at a specific inflection point then, very, very specific. What would it require and what needs to happen for us to step over that threshold and see those Wells and the Morgans and maybe JPM and others actually going, not all in, but, definitely doing the thing, basically?
Let's say all in. I'm bullish enough to think that this is really a mega trend. I will say it happened. So I'll go back to that survey. We've done it for 7 years. We ask people every time, what's the number one thing keeping you from investing in crypto? And you might think it's valuation, it's I don't understand it, it's criminal activity, it's environmental impact, it's all the FUD that we've heard. No, for 7 straight years, it was a lack of regulatory clarity. And if you think about where we've gone over the last 4 months, we've gone from an administration that was overtly hostile to crypto, sitting senators having war on our industry, lawsuits raining down in the dozens, to today, the White House has declared it's strategically important for the country to own Bitcoin, to the degree that for every American, there's now $47 of Bitcoin sitting in cold storage with the government. So we've removed the largest blocker. And now what we really need is time. Wall Street doesn't move at crypto speed. If we remove that largest blocker, let's say in November or January, it could take 12 months before those national account platforms get through the due diligence. But there is nothing that stops this boat, right? This is a tanker that is turned. And I think it's a done deal. I think it's set. I think nothing will slow us down. And I think we've cleared the last hurdle and it's off to the races.
Matt, you're someone who has this perspective of boots on the ground, meeting with advisors, meeting with clients face to face. It's something that I think is pretty unique, in this industry. Not too many folks get to have that type of exposure. I think it'd be helpful, given that, if you could break down kind of like the different types of advisors that you're speaking with and like their categories, and maybe give us some color on maybe what you're expecting as far as their adoption trend. Are you going to see, these smaller RIAs with more of a younger cohort kind of adopt crypto faster? What's your take on wirehouses? If you could give a little bit more color on that and see where we're at. I know that with those, you have a bit more of a due diligence process. So I would love to get your take on how you see the dominoes kind of falling in this hockey stick curve.
Great question. I'm going to vastly oversimplify, but you can think of it in 3 buckets, like easy, medium, and hard. Easy is the RIA bucket. Those are registered investment advisors. They're individual, advisors with their own shingle, and they set themselves up like that so they can do what they want. And what they want is to allocate to Bitcoin. So these were the first buyers. If you look at the 13F filings from the first year of Bitcoin ETFs and you skip past the hedge funds and you get into the RIAs, what you see is these individual shops. And there are thousands of these shops and not all of them own Bitcoin, but many do. And that's really Bitwise's, meat and potatoes. That's our primary audience. One step up from that are various ways to conglomerate independent advisors. And these could be large advisory firms, the creatives or whatever. It could be firms like LPL. They take a variety of forms, but what separates them from RIAs is they have their own due diligence process. And so you need to get through that due diligence process before those advisors underneath that umbrella can really allocate at scale. And that, I would say, is what turned on over the last 3 to 6 months, right? And the thing about these buckets is it's easy, medium, hard. It's also small, medium, large, right? So easy was small in terms of AUM. Medium is now turned on. I think most of those platforms can allocate, and that's pretty big. And then hard is Morgan Stanley, Wells Fargo, UBS, and Bank of America. And where they're at right now is like a tiny trickle, right? They really haven't Morgan approved solicited exposure, but with a lot of hurdles to jump over. No one has turned it on full form, but they're all moving aggressively in that direction. So I think that will come online in the second half of the year. The growth we're seeing right now is from probably that medium bucket. and then from the early bucket that made a 1% allocation and now wants to go to 3%.
And when thinking about that allocation, kind of that move from 1 to 3%, is that all Bitcoin, or are we starting to introduce the crypto sleeve into the portfolio?
Yeah, it's a great question. We've had a lot more questions recently about the crypto sleeve. The thing to keep in mind, or the mental model for this, is think about how you came into the crypto market. I would bet for 90% of our listeners, the first thing they bought is Bitcoin. And for 90% of those listeners, they bought other assets after that, right? That's certainly true for me. I have no idea, but I bet it's true for at least 2 out of 3 of you. And
That's good.
Yeah, that's yeah.
one of you is a total G-Gen. It came in through some obscure coin you were hoping to do 1,000x. I know that, in a sample of 3 crypto investors, that's always true. But the same thing is happening here. So the people who allocated to Bitcoin first are now having conversations about how you build a crypto sleeve. What's a complete crypto portfolio? And that's particularly true because some of the things institutions are most excited about, stablecoins, tokenization, agentic AI, DePIN, DeFi, those don't happen on Bitcoin. So if you just have Bitcoin exposure, you're missing out on that. And I know there are people who think institutions will be Bitcoin only. There's nothing in the history of crypto that suggests that's true. Some of them will be Bitcoin only, just like some crypto investors are Bitcoin only, but many of them will walk down the cascade as so many other crypto investors did.
In the realm of digital asset sleeves, you wrote a memo not too long ago talking about this, and you introduced this model, the 60-30-10 allocation model. I believe it was 60% Bitcoin, 30% Ethereum, and then 10% crypto equities. You still find that to be kind of the reasonable approach, or have things kind of evolved since then, since we've kind of had a little bit more of a regulatory shift or hopes of a regulatory shift on the horizon here?
I think they're going to evolve. The framing for that is I'm the world's only Jack Bogle crypto investor. So I love broad-based indexing. If you look at my equity portfolio, it's like the total world market. That's my approach, right? Just own everything. And I think that makes sense in crypto. The strongest conviction I have in crypto is that this $2.5 trillion industry will be a $25 trillion industry, right? That's what I'm willing to make with the most confidence. That the bet. If you want to make that bet, you want to own the industry. So what is owning the industry? The best version of it would be owning a diversified index fund of crypto assets and then owning crypto equities, because there's part of the market that you don't get in crypto assets. You don't get tokenization, really. You don't get stable coins. You get ancillary exposure to those things. So you want crypto assets and crypto equities. I did 60-30-10 because that's what you can access today in an ETF vehicle. You can access Bitcoin, you can access Ethereum, and you can access crypto equities, and you can put those together 60-30-10. It's a great starting point. In 6 months or a year, if we have an index-based product or we have more altcoins, I would rather have more exposure than just Bitcoin and Ethereum. There's no guarantee that Ethereum is the winning layer one, right? So I would like to diversify that, but it's a really great starting point for people.
Just a little bit of an interjection. I will be cautious in not trying to implicate you in activity which you should not be, because I know that you have an open filing. There's a 10K with the SEC for the BITW. I believe the ticker is Bitwise 10. Now, in light of what you've just been sort of laying out as a potential approach, how would, let's say, any 10 asset or portfolio chosen by a provider, how would that fit in? And it's going to differ, I guess, from case to case, right? Obviously.
Yeah, I mean that would replace the 60-30. I think, again, investors can make bets, but it's what is the starting point? Do you want to overweight Bitcoin? Great, but what is the starting point? So a diversified index. We've been running our Bitwise 10 crypto index fund since 2017, and it reconstitutes every month. It's weighted by market cap, so no matter what's going on in the market, it reflects the market's expectations of the most exciting crypto assets in the market. Now, when you're building an index in crypto, it's not as easy as building it in US equities. You need to screen out certain assets with hidden risk. We're proud that we screened out Luna, we screen out Doge and Shibu, right? So you need an intelligent index, but as a starting point for a portfolio, I think an index is a great place to start. And again, you can overweight this or underweight this, but if you don't have that fundamental starting point, I think you're a little bit lost.
Another kind of great thing about these digital asset sleeves, and we talked earlier about the fundamental drivers and how the correlations might be lower going forward. When you kind of button that up into a portfolio, you can really reduce your volatility, which allows for much larger allocations. Is that kind of where you see this going? Are we going to have different rebalancing strategies? Are we going to see larger digital asset sleeves in the future?
100%. Not only can you reduce the overall volatility, but you actually turn volatility into an asset. So the thing, to put on sort of the academic hat, when you have assets, even that are highly volatile, but you're able to rebalance those assets over time, you can harvest that volatility and turn it into effectively alpha. It's called volatility harvesting. And the beautiful thing about crypto from again, that academic perspective, we've never had a liquid asset that's as volatile as crypto. So volatility harvesting was like something that commodity investors talked about a little bit and was maybe sort of an edge goofy case that people discussed, but it's amplified 100x in crypto. So building a diversified crypto sleeve with multiple assets that are not correlated and rebalancing it can really improve your risk adjusted returns. The other thing it does, Mark, which I think is equally important, is I think it's the ultimate solve for behavioral risks. And the biggest risk in crypto is behavioral. It's like holding a portfolio and then saying, oh, wait, what about bear chain? Oh, wait, what about Monad? Oh, wait, what about this? Right? That's the biggest risk, is the sort of like goldfish risk. And if you own a diversified index product, you have exposure to all of that. And at least for me, for 90% of my personal portfolio, that makes it super easy. I don't have to think about it. I just have exposure. And then I can go total degen on the other 10%, which I think is what many people do.
Yeah, I think we all like to have the degen sleeve, which is something that we're not formally talking about, but I would say it's important because it gives you kind of like the outlet for mitigating that behavioral risk. I mean, imagine if you didn't have the degen sleeve and it was more than 10%, right? You could find yourself completely out of whack as far as, how you're constructing things.
I think it's so important. I think it does two amazing things. Even if it goes to zero, even if you lose all your money, it helps keep the behavior in check for the rest of your portfolio. And it's a massive education. I don't think you can operate in crypto unless you have a portion of your portfolio that you're always experimenting with, even if you expect to lose money there. I actually think it's fine. It's like a tuition. And it's tuition to one of the greatest universities in the world, which is crypto. And so I'm willing to absorb that cost to reap that benefit. So yeah, I encourage everyone to have a little piece that goes total degen.
Just kind of building on that, I've always said that, digital assets kind of offer this shiny new lever to pull for asset allocators. So, I've been in the space for some time and started out in multi-asset portfolio management. And from an asset allocator perspective, it's mostly about just pulling levers, right? Figuring out where you want to be tactically underweight, overweight, neutral. But I get excited knowing that there's this new lever, digital assets, that, we could potentially add. And like you were, adequately highlighting there, talking about the volatility of it, you can use that at your advantage if you know what you're doing. So given that heightened volatility, what are some of the circumstances that you'd want to overweight, digital assets? And maybe now would be a good time to talk about that. We're kind of in this correction. We're seeing prices come down a little bit.
I completely agree. First, just to start a base case, if your weight is zero, you're underweight, right? So every investor who's still on zero is underweight versus the global capital portfolio. You're betting against Ray Dalio, you're betting against Stan Druckenmiller, you're betting against BlackRock's model.
Yeah.
If you're at zero, you're effectively short crypto. So I think that's an important thing to say.
Mm-hmm.
What I think about that volatility, I like to think about sort of the short term and the long term. I'm a long term crypto investor. So if we take Bitcoin as an example, all I care about in Bitcoin is where it's going to end up, right? Is it going to get to parity with gold or higher? Then it's $1 million plus a coin. Great. So What does that mean in the short term? Well, what we see time and again in crypto is that when there's economic uncertainty in the market and the market increases the discount factor for all risk assets, Bitcoin falls because it has elements of a risk asset. But from my view, often in those same moments, the long-term value of crypto goes up. So right now, as an example, we have uncertainty around tariffs, right? Introduced economic volatility into all capital markets. That's caused the price of all risk assets to go down in the short term because that discount factor is higher because the world is crazy. But from my view, governments mucking with the economy makes the case for Bitcoin stronger. So my mental price target for Bitcoin long term probably went from 1 million to 1,000,001. That creates opportunity, right? So when you see events that make the long-term case stronger, but in the short term inject volatility and cause a drawdown, that's like a great time to pounce. And I think we're in that moment right now in crypto. We've had that pullback, that dip, and I think we'll have the rip on the other side of it.
I like that. It's basically like you're saying that what we're seeing now, these short-term dislocations in the market, actually add more credence to the thesis of Bitcoin. And it's really, it's kind of like a store value, sound money principles, an opt-out button for getting out of the traditional financial system. All that stuff is kind of building right now as you're getting discounted prices, in the short term.
Exactly right. It happened during COVID. It happened during the Euro crisis. It happened at the very start of Bitcoin. We've seen this time and again. Short-term economic uncertainty causes risk assets to pull back, but the government eventually steps in, supports all assets, make the case for Bitcoin stronger. It's a really familiar pattern. And I think there are fundamental reasons it exists. And I think again, it's happening right now.
So we have one of the most influential, you talked about education earlier, Matt. We have one of the most influential voices of the industry in the same room with us. Let's go crazy here. Talk about what's actually happening out there, particularly in Washington. So Bitcoin Strategic Reserve, Matt, is it everything that we are being told it is, or how does it pass muster in your mind? How should we view it?
I think it's a bigger deal than the market has realized. I mean, first of all, think about the words you just said, Ken. A US Bitcoin Strategic Reserve. Those were crazy words a year ago. You would have got laughed out of any polite room until August of last year. That was a fantasy dream that Bitcoiners told themselves when the markets were volatile so they could go to sleep. And yet here we are today. I think it's all of that and then some. So the two things that I would call out, one, they made it Bitcoin only, which is really important because there is a macroeconomic case for the US government to own Bitcoin, and there really isn't to own these other assets. And so if it included all these other assets, it would have been clear that it was a political play and not a geopolitical play. And you want it to be a geopolitical play. So that's how it was set up. And then the thing I think that the market missed is, the market got all upset that they didn't smash by 200,000 Bitcoin straight out the gate. But the executive order said they shall look at ways to add more Bitcoin. And we heard that again at DAS. They want to own as much Bitcoin as they can. I think the US government is going to buy Bitcoin this year. And I think when people realize that game is on, I think it's going to be transformative for the market. So I'm very excited about it.
And implementation at all? I mean, you concerned about some of the sort of ways that it looks like they're going to opt to actually make this thing happen? I mean, the other thing, of course, is the background of it is that we seem to have more than one new digital assets strategic reserve, right? We have the Bitcoin. I mean, that's been clarified, but it looks like we're also going to be buying other digital assets as well. And that's kind of muddied the water a little bit in many people's minds. Maybe to a small extent reduce the impact of the message. I don't know. What do you think about it?
I think it's reduced the impact of the message. I think that is right. I think it muddied the water in the media. I think it makes it, again, look more political and less geopolitical. But ultimately, like the fact is we have a US strategic Bitcoin reserve. The fact is other governments are going to develop their own strategic reserves. The fact is I think we're going to end up buying more Bitcoin. And I think that's transformative for the market. I often say, like, the only question that matters in Bitcoin, the way to judge every single news event is Does this make this more or less likely that Bitcoin is a geopolitically important macro currency in the future? And if that is your question, the US establishing a Bitcoin strategic reserve, and in my view, buying more Bitcoin, is screaming yes. And so therefore, extraordinarily bullish. Yes, the message could have been delivered a little bit better. Yes, the market wanted them to buy immediately, but the long-term investor in me says it's a transformative bet.
Okay, so I love all these explainers. I just want to highlight, we're seeing gold rip, past 3,000 right now. There's, I think, two factors behind that. One is this arms race to acquire, gold stockpiles, particularly after, the geopolitical tensions that arise after the Ukraine war, where, the US dollar was kind of used as kind of this more of a weapon to kind of make life difficult for Russia. And I think other countries saw that and said, maybe it's time for us to kind of diversify our holdings away from treasuries, start holding something else. So gold became an obvious choice. Also, we have geopolitical uncertainty that keeps just showing its ugly face, and that tends to be kind of credited to kind of give a bid to gold. But what you're describing to me is we could potentially see a world where Bitcoin kind of kicks off its own arms race, with countries. And this is kind of like the first step with the US, making this executive order. And do you think that's us kind of figuring out a way to sidestep the gold route? I mean, because I don't think we're talking about, strategic gold reserves anymore really as much. It's mostly being focused more on the digital asset plane. So I'm kind of curious to get your take. Do you think Bitcoin's going to kind of stand alone on this footing, especially for maybe Western democracies like the US, to kind of just stay on the Bitcoin track and avoid the gold track for now?
Yeah, well, first of all, you're absolutely right. You're seeing governments around the world, hoover up gold, which is increasing the size of the store of value market that Bitcoin participates in. I go back to the same thing we were talking about earlier, Gabe, which is the default position should be the neutral portfolio. So if you look at the hard money store of value market right now, it's $20 trillion gold and $2 trillion Bitcoin. If you're a central bank that's 100% gold, you're missing 10% of the market. What are you doing? You're making an active short bet that this thing that has been the best performing asset in the world for the last 15 years, that appears ascendant, that's on the digital side, that is more functional as a currency than gold. You're making a strong short bet that it won't be important in the future. That's wild. That's crazy. That's huge risk. So even if I look at like the US and its gold holdings, it strikes me as irresponsible to be 100% gold, 0% Bitcoin. And so, I don't know that the US is going all in on Bitcoin. That might be equally irresponsible if you're talking about, 100-year patterns. I think Bitcoin is ascendant, but I wouldn't reject people who said there's risk in that we should also own gold. But there is equal or more risk in being gold only. And so I think what you're going to see is Western governments catch up to the market neutral portfolio and then maybe allocate more to Bitcoin than the market neutral portfolio would suggest, because it's been so attractive and its future is so bright. But I really think that's what's going on. It's not like they're YOLOing into Bitcoin. It's they're looking at the market weighted portfolio of store of value hard assets around the world and realizing they're systematically underweight and they have to catch up. And to do that, they're going to have to buy a lot of Bitcoin.
One thing that's interesting about Bitcoin versus gold from a store of value perspective, it's that you as a network participant are able to participate in its security via mining or hosting nodes. And we've seen some countries in emerging markets look into mining, presumably for national reserves. Is that something that you think we'll see more nation states get into, or is mining something that's more for the private sector?
I think it's going to be everyone, everywhere, all at once. So definitely nation states are going to want to have a piece of this network. There are also many nation states that have a lot of wasted renewable energy that want to monetize that. And I think you'll see that be an important part of the network. I mean, I think if you're a country and you're looking at this at a 100-year thing, are you really going to write down the possibility that gold is used as an apolitical, or Bitcoin is used as an apolitical currency in the future to settle international transactions? Do you really want to be at zero when the rest of the world is at one? So I think you're going to see nation states move into mining. What we want as a network is a broad distribution of ownership, a broad distribution of mining, lots of different actors. The more different actors with different points of view participating in this market, the more stable it is. And so I think we should welcome all of these things. I'm not one of those that worries, about governments getting involved, because I don't think they're going to get to a majority position. And again, I go back to that core question, will Bitcoin become a geopolitically important macro asset? There's no world where that happens where governments aren't involved in holding Bitcoin, in mining Bitcoin. And so that's part of that needed progression. And I think it's something we're definitely going to see.
Just quickly, maybe we can touch on the stockpile, which is outside of Bitcoin. So these are assets like Ethereum or Ether, Sol, XRP was named as well. I think ADA was named. What criteria should determine which assets maybe, or in your view, and or you don't have to, hold your feet to the fire here. We're just kind of spitballing, but what's your take on the stockpile? Do you think it's that we should be kind of dipping our toes into these other assets, or would you have liked to have seen a Bitcoin only focus on the government side?
Yeah, I would have done a Bitcoin only. I may be out of step with the crypto community. Look, I'm very bullish on non-Bitcoin assets, right? Remember, our flagship product is an index fund. I'm calling for DeFi Summer 2.0. Very bullish. But from a national perspective, I'm not sure what the stockpile does. I sort of think of it almost as a subsidy to US crypto industry. We subsidize various industries in the US because we think they're important. This is a way of subsidizing that industry by removing liquidity from the market and sort of, granting some sort of regulatory pass to certain assets. So if that's the intent of the policy, I guess we should favor US developed and domiciled assets that we want to see play an important part in the world. But I think thinking of at least for my framing, I think of the stockpile as sort of a subsidy for the crypto market. I'm not a huge fan on corporate subsidies from the US government. So I've mixed opinions about the stockpile itself.
That's fair. I think I was surprised to see actually so many industry leaders kind of spoke out against including other assets. So I think there's quite a few other folks in that camp, including myself. And we had Marco Santori on, not too long ago. And he also mentioned the risks of opening up a reserve or stockpile to other assets. And I think that's perfectly kind of reasonable to kind of have those concerns and kind of point these things out. But gentlemen, we're coming close to time. Shall we do our final wrap with some market chatter?
Absolutely. Why don't you kick things off with your recent research, which you surfaced in the QAR, about the market breadth and what that's potentially telling us about the regime that we might be heading into?
Well, yeah, like I said, Mark and I do this attribution report every quarter where we measure kind of the performance of our indices in a similar fashion that you would for any type of attribution exercise on a multi-asset level. And of course, here at CF Benchmarks, we have our digital asset classification structure, which we break all these tokens out into. We can kind of measure the attribution that way. But with that being said, we do like to measure, the broader market as broad as we can. We have the CF Free Float Broad Cap Index, which holds about 50 tokens or so right now. And we saw a bit of a warning sign with that index, where we saw basically the number of constituents that are below their 200-day simple moving average breached 90%. So this is a threshold that we typically kind of see when we begin to see a downtrend, a correction, if you will. And that's certainly, I think, where we land right now. Unfortunately, the data does not look too promising in the near term. I think we're still looking at some chop or some downside risks in the near term. Certainly, we don't have the geopolitical tailwinds anymore helping us. So with that, I think it'd be interesting to get your take on what you're seeing in the market. Do you think now's a good time to be adding, or do you think there's more downside risks in the near term? Similar to history, I think this time is unique. We do have, a lot of regulatory stuff happening in our favor. That's not been the case before, so we have to kind of factor that. But certainly, crypto winters can be brutal, and I'm not saying that we're heading towards one right now, but this downside momentum certainly seems a bit bearish at the moment.
Yeah, I agree. It's bearish, and that sort of 90% number speaks to the vibes in the crypto native industry. I think it's going to be a pick and choose sort of market. Actually, that's my expectation. We talked about, at the start, how I think correlations between assets will fall. I think Bitcoin is in a unassailable bull market. I don't want to keep harping on Bitcoin, but there's a structural imbalance between demand and supply in Bitcoin. We're producing 160,000 Bitcoin a year, and ETFs bought 500,000 last year. Corporations bought 250,000. There's just more demand than supply. So I think Bitcoin, maybe it has some downside back to its previous all-time highs, but I think this may be the best time to buy Bitcoin on a risk-adjusted basis in its history. Outside of Bitcoin, I do think there is risk in lots of parts of the market that is sort of grappling with this transition from speculation to fundamentals. An analogy from tech is you monetize a company, you start raising revenue, and all of a sudden you're valuing on fundamentals. You're like, oh my God, Facebook is at 1,000 PE, right? And it takes a while for that to catch up. Now, I do think we'll catch up. I think what you'll see in the remainder of this year is idiosyncratic assets outside of Bitcoin doing exceptionally well. I think there's a huge amount of value in the DeFi space, and we're already at all-time highs on many TVL metrics. And I think that space will probably come into its own relatively early. I think there may be sort of contrarian purchasing waves in assets like Ethereum, which are really beaten down from a narrative perspective, but actually have some fundamental exposure to stablecoins and tokenization. And if that catches a bid, I think it could be a nice contrarian play. But I don't think it's going to be easy outside of Bitcoin. I think you're going to have to pick and choose, and there'll be assets that do spectacularly well and assets that do spectacularly poorly. I think the dispersion will be really wide and the correlation's relatively low. All that said, I think we are at the start of a new 4-year cycle. People talk about cycles. I think the election restarted the cycle. So I don't think we're entering a crypto winter. I think we're in that sort of almost uncomfortable first year of a crypto cycle. The last one only lasted 2 years. It was short-circuited by this election because it's such an epochal change. So I think we're in that first uncomfortable year of a new bull market, but I think that bull market is going to extend for multiple years.
I really like what you said about us getting back to looking at the fundamentals versus some of the speculation and hype. And we've almost seen this in some of our category indices. I've seen a lot of the NFT protocols fall more than 50%, or if you look at our digital culture index, that was down about 50% last quarter. And I'm sort of wondering, have we seen all of the fallout from the speculative craze on Solana and to an extent on Ethereum too? Or is there more to come there?
Oh, that is really the precise question. That's a great question. I think if you think about something like Solana, it's coming off this meme coin driven narrative growth, and it's a fundamentally disruptive, wonderful technology. And so I don't know where we are on that bottoming curve, but I suspect it is a bottoming curve. I'm not sure it's a V-shaped turn. It needs to sort of digest that past narrative and move on to the other narrative. The other narrative, for what it's worth, is 100xing the users, right? And really becoming an important part of the economy. I think we're going to get there, but are we all the way down that speculative curve? I'm not sure. There is still risk in this market from that perspective.
Yeah, you mentioned Solana there, and I can pose a question that includes both Solana and maybe XRP, because overnight we got news that the SEC has basically dropped its appeal against Ripple Labs. This thing's been going on for at least 2 years, probably longer, or probably more like 4 years, actually, in total, including the appeal, which seems to, remove a few shackles in terms of the outlook for investment products. A number of issuers have got filings at the SEC for XRP ETFs, and likewise, a number of issuers have got filings at the SEC for Solana ETFs. Now, I'm not going to ask you to necessarily choose in terms of the chances, but we do have, for Solana, of course, last week, the CME group launched only its third crypto asset on its platforms, and that was, of course, Solana. And we had this sort of idea that tacitly over the years that having a CFTC-regulated DCM and DCO basically was one of the, I guess, stealth requirements that you needed before you could see an ETF in a digital asset. So with all that, bearing all of that in mind, would you say Solana's chances of sort of like the Solana filings have a slightly higher chance than the XRP filings at the
Yeah.
moment? Or
I think that's a rational take for sure. Yeah, I agree with that. Not just in crypto, but in ETF history, there's always been futures trading alongside spot commodities when you get ETPs. That was true of gold, it was true of silver, it was true of palladium, it was true of platinum, and on down the list. So I do think the fact that now we have regulated futures is a big deal. So I think that makes Solana, the next most obvious candidate. I think we're going to get a lot of ETPs eventually, but if this is a crawl, walk, run, Solana does seem to tick most of the boxes at this point. We'll see what happens, but I'm pretty bullish on Solana.
Great. I think maybe we can kind of start to wrap things up. And with that, I want to give you kind of like the final say here, the final closing, statements here. And I would be remiss to not kind of point out your recent memo titled Dip Then Rip. And so, which is a great name. I think, maybe it'd be great to kind of just give the listeners a brief summary of the dip and rip. What's your final takeaway, for the listeners that might be feeling a little bit more anxious about, this heightened volatility in the market? Maybe highlight that piece, and then, what should we expect to kind of wrap things up?
Yeah, I appreciate it. Yeah, so the thesis of that piece is to explain a phenomenon that we all experience, which is there's market turmoil and Bitcoin pulls back and then it rebounds. If you look at all the times in the last decade, the S&P 500 has fallen 2%. Bitcoin, which is theoretically a hedge asset, has fallen 2.6% on average on those days. So that stinks and it feels bad. But then if you look at the year that follows, on average, Bitcoin has gone up 190%. So dip and then rip. What I did in the piece is explain why, from an academic valuation perspective, that makes sense. Because the dip reflects the higher discount factor that we apply to markets when they're volatile, which causes, because you're compounding over many years, the price to go down. But the rip reflects the fact that we talked about earlier, that all this government intervention makes the long-term case stronger for Bitcoin. And so that was the gist of that piece. I think it speaks to what people should be thinking about right now in this market, which is if you step back, if you're able to step away from the screens, close the screens, go outside, walk your dog, and think about what happened in crypto over the last 6 months. We have made such enormous progress, right? From a regulatory perspective, with the SEC shutting down all its lawsuits, from a legislative perspective, with the outlook for stablecoin legislation, market structure bill, from an institutional adoption perspective, where now we barely shrug when we learned that Abu Dhabi's sovereign wealth fund bought $500 million of Bitcoin ETF. We're like, yeah. To the White House calling it a strategic asset for the United States to hold forever and to buy more. So much good news. Ignore the short-term volatility or profit from it. I really think the long-term case for crypto, not just Bitcoin, but other crypto assets as well, has never been stronger, at least since I've been in the market full-time for the past 7 years. And I think if you keep that long-term view in mind, it's really hard not to be bullish. And it's really hard to care if you get in at 80 or 70 or 90. If we get to where I think we're going, those little details aren't going to matter.
Well said.
I think we're not going to get a more succinct wrap up of this show than that. That was awesome.
Yeah, that was great. There you have it.
Amazing conversation with Matt Hougan, as usual, insightful, informed, as you'd expect for the CIO of one of the most foremost digital asset first investment management firms. Always a great pleasure to have him on. If you enjoyed that show, we do have several others out there now. Wherever you get your podcasts, navigate there and get those episodes. If you like our other content, cfbenchmarks.com is where you need to go. And we'll see you again for another episode of CFB Talks Digital Assets. Thanks for joining us.
Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice.
This recording is not intended to persuade or incite you to buy or sell any financial products noted within, including but not limited to exchange-traded funds, mutual funds, equities, other instruments that reference any index provided by CF Benchmarks Limited, or crypto assets. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making an investment decision. Note, some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.